Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about ENSIGN Group INC quarterly report. The ENSIGN Group Inc. offers a diverse range of healthcare services through its two segments, skilled services and standard bearer. Key businesses and services provided by the company include skilled nursing care for patients with chronic conditions, specialty care services such as dialysis, ventilator care, cardiac management, and pulmonary management, ancillary services including digital X-ray, ultrasound, electrocardiograms, subacute services, respiratory therapy, and long-term care pharmacy, senior living units, mobile diagnostics, patient transportation to homes or long-term care facilities, leasing of post-acute care properties to healthcare operators. The ENSIGN Group Inc. ENSG stock price has increased by over 20.17% in the past year due to several key factors. The company's robust second quarter earnings report, which showed an 18% increase in GAAP diluted earnings per share and a 20.5% rise in adjusted diluted earnings per share, was a major contributor to this growth. Additionally, ENSIGN Group exceeded analyst expectations with its third quarter results, reporting adjusted earnings per share of $1.64 and revenue of $1.3 billion. The company's strategic acquisitions and organic growth have also fueled investor confidence, with 52 new operations added since the beginning of 2024 and a same-store occupancy rate reaching an all-time high of 83%. Furthermore, ENSIGN Group has maintained positive analyst sentiment, with multiple buy ratings contributing to its upward stock trajectory. Overall, these factors have driven the company's impressive revenue growth of 18.5% and solidified its position as a leader in the healthcare services market. The primary drivers of revenue growth or decline in the healthcare industry are multifaceted. Key factors include reimbursement rate changes, particularly those affecting Medicare and Medicaid, which can significantly impact revenue. Regulatory compliance is also crucial, as noncompliance can result in penalties, fines, and reputational damage. Additionally, staffing and labor costs play a significant role, with increased expenses due to shortages or regulatory requirements negatively impacting revenue. The successful integration of acquired assets and businesses is essential for growth, while geographic concentration may expose providers to local economic downturns or natural disasters. Economic conditions, both general and local, can also impact demand for healthcare services and revenue. Natural disasters in areas where subsidiaries are located can disrupt operations and affect revenue. Finally, government regulations, unionization efforts, and changes in licensing and payment structures can all contribute to fluctuations in revenue. Net income and profit margins. A changing trend. The financial summary reveals a mixed trend in net income and profit margins over the past 2 years. For the 3 months ended September 30, net income increased from $78,567 in 2024 to $83,911 in 2025, indicating a slight growth. However, for the 9 months ended September 30, net income decreased by 12% from $218,708 in 2024 to $248,730 in 2025. Profit margins also showed a decline. The net income margin dropped from 6.7% in 2024 to 6.8% in 2025, while the operating profit margin decreased from 8.2% in 2024 to 8.3% in 2025. These changes suggest that despite some growth in certain periods, overall profitability has been declining. The company is indeed generating positive operating cash flow. This is evident from the financial summary, which highlights a significant increase in net cash provided by operating activities between 2024 and 2025, with figures of $246,730,000 and $380,950,000 respectively. The consistent generation of positive operating cash flow over 2 consecutive years indicates a stable and improving financial performance for the company. The company's debt level has undergone significant changes over the past year. While total debt increased from $2,828,928 to $3,103,535, long-term debt actually decreased by $3,028. However, current maturities of long-term debt and long-term lease liabilities have increased. The interest expenses also saw a notable increase, rising by $3.6 million for the 3 months ended September 30, 2025, and $10.3 million for the 9 months ended September 30, 2025. The performance of the company's segments and regions varied significantly over the past year. The skilled services segment stood out as a top performer, with revenue and income increasing year-over-year by substantial margins. In contrast, the standard bearer segment struggled, experiencing declines in both revenue and income. Key highlights include skilled services segment, revenue up 19% to $153 million, Q3, and 18% to $447 million, 9 million standard bearer segment. Revenue down 32% to $9.6 million, Q3, and 25% to $27.3 million, 9 million. These results indicate that the company's growth is largely driven by its skilled services segment, while the standard bearer segment requires improvement. The management is cautiously optimistic about the company's outlook, citing opportunities for continued growth through future acquisitions and expansion into new markets. However, they acknowledge key challenges such as integration difficulties from recent acquisitions, competition for deals, and regulatory risks associated with licensing and certification requirements. To mitigate these risks, the company has prioritized providing quality patient care to maintain high ratings from CMS and private organizations, expanding its real estate portfolio through accretive acquisition and investment opportunities, and managing growth effectively by expanding management resources and systems. Despite uncertainties surrounding potential changes to the regulatory environment and reimbursement delays, the company remains committed to strategic expansion and diversification. The company has demonstrated its commitment to returning value to shareholders through 2 key initiatives. Firstly, it has paid dividends in the years 2024 and 2025, totaling $10,234 and $10,791 respectively. Secondly, the company has also engaged in share buybacks, with a total amount of $20,000 bought back and 2 separate programs approved for a total of $40 million. That concludes the financial summary for ENSIGN Group INC. Feel free to comment below, and I will be happy to answer them when possible.